We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to look a bit deeper into the kitchen cycle on the SP500. We're going to use our fixed cycles, which we have here, which we call the wall cycle. That's W-A-L-L with my accent. And we're going to look at the our adaptive cycle, our Hurst DPO cycle. So here we have the SP500 going back to 2007 to current. We have the wall cycle set with 900 bars, the purple, and the subset with is 297. Okay, and down here we have the 900 DPO 450 because we divide that by 2. Okay, so the first thing to notice is this cycle is present in the market. Okay, so we have peak in 2007, a peak here, 2011, a peak at 2015-16, and it's forecasting some sort of peaking action 2018. So what does the cycle tell us? Let's look at a fail, well, you know, a cycle actually saw a sell-off. As you can see here, the major kitchen cycle is rolling down, and so is the sub-cycle. Okay, down here. So price peaked here. Okay. Now it goes through and does like a typical correction to about there. Right. But we have failed strength here. Okay, that's when the market really collapsed. Once the market fell to that point there, the market rolled over and realised there's no saving it, and boom, we're gone. All the fundamentals from Bear Stearns and valuation of the paper assets relative to the housing market just started to accelerate. Okay, compare that to 2011. This was the I think the US was downgraded, the Fed started taking money out, what have you. We have our period of shading there. Market peaked, where are we? Down there. Okay, sold off here. Now as you notice, in this particular case, we had some strength here. That broke the cycle. It broke the downward cycle. Okay, the market following the cycle down based on fundamentals, it was going down. Okay, the important part here, the rally, I mean, we should say positive. The rally from 2009 all the way up to here was a good rally, so you're pretty much in line with the trend, in line with the cycle here. But the red zone is the warning zone. It's the warning, it's the zone to take care and to be aware. Okay, so we actually had the start of a downward cycle. Strength came in and it created an inversion to the cycle. Okay, this did not happen here, it failed here. Same again here. Okay, we had a peak actually, where are we? About there. Okay, some weakness come in. The weakness is a bit late in the cycle. But then we got some strength. This is the US elections. Okay, and it took off. Oh, so the US elections are here. Right, that's about right. But this is, I think this strength out of nowhere, this strength here, out of pretty much nowhere. I think there's pretty much central banks saving the day. That's my humble opinion. Okay, so the cycle's working. I mean, one has to note that the long period of trend eventually requires some, you know, profit taking, because you've got green on the screen and the psychology changes and sentiment changes and people start getting a bit nervous because they've got lots of green on the screen and realise they want to keep the green. Yeah, take some cash or whatever, they get a little bit flighty. Okay, it's just normal risk behaviour. So here we are again. Same sort of scenario. We've got a peak about there. Well, it's obvious to see. But now we're entering the red zone. So we've got lots of profits on the screen after a long period of a markup. So we have to ponder what's going to happen between here and I would say about there, which is the second half of 2018. So once again, the mindset's the same. We've had lots of profits, profit build, green on the screen, and now the money managers out there want to keep that green. So they don't want to let it go red. I mean, once you're a fund manager and you made money, the last thing you want to see your 50, 70, 80, 100% profit go down to zero or worse. So they're going to get a bit flighty as the fundamental news comes in with rising interest rates and all the spin on that. Talk of Trump, talk of trade, change in fundamentals, change of inflation, change of the rotation. So I do suspect we're going to get some sideways action as we saw here. Probably not so as violent as this one, but definitely going to get some action like this. I think SP500 2000 top, up and down, sideways. You may even get a new high. That'll be totally within the expectation. But watch for sudden drops. Now, where can it go? So where we are here, I would suspect where are we? About just above 2.4. The market went down there, did a test, carried on. It'll be just like the behaviour here, and it's like the behaviour there. Obviously, in the worst case scenario, it goes down there, does a test, and it fails, and it goes down a lot lower. But I think the point in time is, the warning is we are now in the red zone. We're now, after we do have a period of profit accumulation. People want to keep those profits, and the news that's coming into the market now is going to spook those people out there. So people are wondering, will Powell Central Bank save their day? Will they print money to maintain this pattern? That's what they're wondering. So smart players will be working out rotation. They'll be just moving a little bit of funds onto the other sectors. That's the utilities, staples, gold, silver, metal stocks, because obviously the inflation worry. Adjusting out of the emerging markets because of the strong dollar, what have you. Just, slightly ticking away. That's why the US dollar's gone up, quite frankly. That's because I realise things are changing out there with the inflation. It's just a warning. It's not going to accelerate until really it's come quite clear. So if you're a retail investor and you're looking pretty happy and you've got your gains from here, and you're wondering whether it's just going to go straight up from there, I'd think very carefully about that, and you really want to wait for some strength. Take some cash off the table based on what's going on with the cycle. Thanks very much for watching.